Money banking and capital markets. A money market may be defined as the market for lending and borrowing of short-term funds. It is distinct from capital market, which deals with long-term funds. The RBI occupies a pivotal position in the money market as it controls the flow of currency and credit into the market. The Indian money market consists of two parts. The organized sector comprises the RBI, the SBI and its associate banks, and 19 nationalized banks and other private banks. And the unorganized sector consists of indigenous bankers who pursue the banking business on traditional lines. Call money. It is money borrowed or lent for a very short period. Call money market means interbank transactions on a day-to-day basis. This is the most sensitive segment of the money market. A high call money rate would mean scarcity of funds and tight money market, while a low call rate would mean easy availability of funds. Treasury bills are short-term money market instruments which are issued by RBI on behalf of Government of India. The Government of India uses these funds to meet its short-term financial requirements of the government. Treasury bills are basically of two types, ad hoc and regular. There are treasury bills of 14 days, 91 days, 982 days and 364 days maturity. Commercial bill, it is a short-term, negotiable and self-liquidating instrument with low risk. It enhances the liability to make payments in a fixed date when goods are bought on credit. Gilts indexed security, it is government security that is a calm by the government and is a secure financial instrument which guarantees certainty of both capital and interest. These securities are free of default risk, of credit risk, which leads to low market risk and high liquidity. Conventionally, the banking is defined as the acceptance of deposit of money from public for the purpose of lending and or investment. The banking system in India consists of public sector banks, private sector banks and cooperative banks. The Reserve Bank of India was established under the Reserve Bank of India Act of 1934. On 1st April 1935, it was nationalized on 1st January 1949. It is the Central Bank of India. The monetary functions of the RBI include control and regulation of money and credit, control of foreign exchange operations, acting as a banker to the government, banker's bank and lender of the last resort. The non-monetary functions of the RBI are related to the promotion of sound banking system. Functions of RBI include regulation of credit, issues of notes and coins, regulation of foreign exchanges, bankers to the government and commercial banks. Bank rate, it is the rate at which the RBI gives finance to commercial banks. In other words, bank rate is the rate at which the RBI extends credit to commercial banks. Cash reserve ratio, it is as per the RBI Act 1934 stipulates that a commercial bank is required to keep a certain percentage of its total deposit with the RBI in cash. CRR vary between 3% and 15% of the total demand and time deposits. Statutory liquidity ratio SLR, it is the ratio of liquid asset which all commercial banks have to keep in the form of cash, gold and unencumbered approved securities equal to not less than 25% of their total demand and time deposit liabilities. Open market operations, these are operations which involves the sales of purchases of government securities by the RBI under OMOs. When the RBI sells government securities in the market, it withdraws money liquidity from the market and thus reduces volume of credit lending to control inflation. The 10 repo exercised by the RBI in respect of government securities sold by the RBI to commercial banks with a promise to repurchase them at a certain price. Repo rate injects liquidity in the market. Reserve repo rate, it is the rate at which banks park short-term excess liquidity with the RBI. Reserve repo rate withdraws liquidity from the market. In May 2011, the RBI introduced a new instrument called the Marginal Standing Facility, under which all scheduled commercial banks can avail from the RBI overnight funds up to 1% of their net demand and time liabilities. The base rate, it was introduced on 1st July 2010, replacing the age-old prime lending rates PLR and benchmark PLR. The base rate, the floor below which the bank cannot lend even to its topmost client, is arrived at after factoring in a bank's list of funds and other operating expenses. A commercial bank can be classified into scheduled banks and non-scheduled banks. A scheduled commercial bank is bank which has a paid-up capital of 5 lakh and above, and which is listened is the lend schedule of RBI Act of 1934. Rest is a non-scheduled bank. The first purely Indian commercial bank set up in India was Punjab National Bank in 1894. The State Bank of India was set up in 1921 as an imperial bank and was nationalized on 1st July 1955. There are 7 banks in the SEBI group known as Associated Bank of SBI. In order to have more control over the banks and large commercial banks which had total deposit of 50 crore and above were nationalized on 19th July 1969. 6 more banks were subsequently nationalized in 1980. Banking selection reforms in India were conducted on the basis of Narasimham Committee reports and second 1991 and 1998 respectively. Basel Accord, it refers to a set of agreements set up by Basel Committee on Bank Supervision (BCBS), which provides recommendation on banking regulations with regards to capital risk, market risk, and operational risk. Basel I, prescribing a set of minimal capital requirement for banks, was introduced in 1988. It is primarily focusing on credit risk. Basel II aims to strengthen Basel. The Basels consist of 3 pillars: wise minimum capital requirement, supervisory review, and market discipline. Basel III norms become operational from 1st January 2013. It is being introduced to strengthen existing capital requirement and introduced a global liquidity standard to enable banks to weather financial storms. The Bank for International Settlement (BIS), it is an international organization for central banks which caters international monetary and financial cooperation and serves as banks for central banks based in Basel, Switzerland, and BIS was established by the Hague Agreement of 1930. Regional Rural Banks (RRBs), it was established on 2nd October 1975. RRB are working in all states except into gilts-edged market on government and semi-government securities, industrial securities, market development, financial institutions, and non-banking financial companies. The gilts-edged market, it is a market for government and semi-government securities which carry fixed interest rates and backed by RBI. The industrial securities market is the market for equities and debentures of companies of the corporation sector. Bombay Stock Exchange is the oldest exchange in the Asia, located in Mumbai. It was established in 1875 and it is the longest security exchange in India with more than 6,000 listed companies. BSCs measuring using the BSE Sensex or the BSE 30th index This index composed of 30 PSC stocks. National Stocks Exchange for India (NSE). It was established in 1991. It is one of the most advanced stock exchanges in India. It is located in Mumbai. Over-the-counter exchange of India. It was incorporated under the provision of the Companies Act 1956. In a public limited company, it allows listing of small and medium-sized companies. The capital market of India is regulated by SEBI. It was established on 12th April 1992. The basic functions of SEBI was established on 12th April 1992. The basic functions of SEBI is to protect the interest of investors in securities, to promote the development and to regulate the securities market. Insurance has been an important part of the Indian financial system. This industry includes two sectors, life insurance and general insurance. Life Insurance Corporation, it was established on 1st September 1950 to extend the sphere of life insurance and to cover every person eligible for insurance under insurance umbrella. General Insurance Company, it was established on 1st January 1973 with its four subsidiaries: National Insurance Company Limited, the New India Assurance Company Limited, the Oriental General Insurance and United India General Insurance Chennai. Insurance Regulatory and Development Authority, it was established on 19th April 2000 to protect the interest of the holder of insurance policies and to restore, promote and ensure orderly growth of the insurance industry. Macroeconomic problems in India. Inflation refers to the rise in general price level in the country over a period of time. During the time of inflation, there is an increase in the money supply. Inflation reduces the purchasing power of money. Inflation reduces savings, pushes up interest rates, dampens investment, leads to depreciation of currency, thus making imports costlier. Deflation refers to a general decline in prices often caused by a reduction or is the supply of money of credit. It can be caused by a decrease in government, personal or investment spending. There are various types of inflation. There are demand pull inflation, cost push inflation, profit push inflation, structural inflation, etc. Demand pull inflation is most common type of inflation. It is caused by increasing in demand due to increases private and government inflation, etc. Demand pull inflation is most common type of inflation. It is caused by increasing in demand due to increases private and government spending, etc. Cost push inflation, it is caused by reduced supplies due to increases prices of inputs. Example, crude prices globally have gone up, causing supply constraints, which means higher cost of production, so higher prices. For the measurement of inflation rate, various indexes are used in India. There are mainly two types of indexes, namely Consumer Price Index and Wholesale Price Index, are used to calculate the inflation rate.